Good morning. This is Andy from Two Gray Beards. Nick and I will go through what happened last week, which at the high level was nothing. Nick, what'd you think?
Yeah, I tweeted all of Friday that the realized volatility in bonds and in gold and in equities month on month was nothing. The Nasdaq closed exactly where it opened. Bond yields were absolutely unchanged on the month. So it's not really surprising that cash is actually one of the best assets to own, yielding 5%.
Yeah, so let's just briefly go through the news because there was news. First Republic Bank looks like it'll get resolved over the weekend in some way. That created a lot of downside volatility. Again, nothing happened, but whatever downside volatility we had was concern about First Republic Bank. And we had a lot of earnings, which were mixed, but a couple of stocks, Microsoft and Meta notably, exploded higher on good earnings. The rest of the big tech complex, Apple's next week, but the rest of the big tech complex was um, less impacted. Um, so that was the big news. There was also some news in Japan, which turned out to be nothing much. Markets were prepared and hedged for hawkish, and what we received was nothing.
Yeah, and really, it's this nothing which is causing asset prices to levitate. Because as volatility falls, vol targeting funds have to re-leverage and therefore buy assets, whether it's bonds or equities, mainly equities. But if bond volatility is also going down, that drags equity volatility lower, and these funds have to re-leverage. And that is why you get this yo-yo, you get a dip on bad news, volatility stabilizes, doesn't go much higher, starts falling again, the market then levitates back up to where it came from. It's basically a yo-yo at the moment, and I don't see what's going to change it in the short term, even though we do have a hell of a lot of news next week that could potentially impact things.
So let's talk. So that's last week. We want to be snappy here. Next week, there's a lot of news, and when we look at it, there's a number of items. Firstly, it's very likely that on Sunday night we get a full resolution of the First Republic Bank situation. On Monday, we get some information from the Treasury about their issuance schedule, the total quantity. That'll ignore the debt ceiling. So, those numbers, because the deficit is rising with low tax payments, will be eye poppingly large in terms of supply. But that supply isn't coming unless the debt ceiling is resolved. On Tuesday, not much news, but the Treasury will be meeting with its advisory committee, and the Fed will be meeting in the FOMC. And on Wednesday, we'll get information from both of those sources. The first being the composition of issuance and of from Treasury again, which will ignore the debt ceiling, so will be large, but won't come to market until the debt ceiling is resolved. And then that's at 8:30. And then at 2 we'll get the Fed. What do you think the Fed's going to say?
I think it's almost guaranteed they do 25 basis points. Personally, I think they're going to stress the data dependency from now on, which the market might take as bullish, but they shouldn't. I think the Fed is going to be very uncomfortable with the fact that unemployment has not started rising at all yet. And we do have non-farm payroll next week, which, although they won't have that number when they make their decision, not a single data point that we've had so far in reference to unemployment has been weak. And therefore, there is absolutely no reason to believe that non-farm payroll will be weak. In other words, the Fed is still behind the curve, or they will feel that they're still failing in their strategy of getting unemployment higher to get some sort of a recession going, or a very mild slowdown at the very least. And this fact that equities are levitating at these higher levels enhances the wealth effect. People feel, well, they're spending money. And therefore, I think the Fed is going to be very uncomfortable with supplying more fuel to this fire. They definitely want conditions, monetary conditions, to get tighter. Otherwise, they would not be hiking rates. And I think if they come out dovish, or the market interprets their message as dovish, they will actually have eased financial conditions further. So why on earth did they hike? To me, it makes no sense at all. And I think that any kind of a spike in assets on a Fed, on the interpretation of the Fed has done everything they're going to do, and now from now on it's all downhill, is a big time sell, especially in bonds, and that's what I'm looking forward to. On a leverage basis, that's not something that we do here, but I'm just saying that should you see a big spike in asset values after the Fed, uh, it's not something that you want to buy. It's something that you want to use as an opportunity to actually lighten up.
Yeah, I agree. The odds of a dovish, so interpretation will be what it'll be. We don't know how will investors interpret it. But I think the intent of a dovish surprise would be to deliver 25 and a dovish surprise subsequent to that in the press conference seems to have no upside whatsoever.
It's pointless,
Right,
absolutely pointless. Why
right.
do they tighten?
Right. Now that doesn't mean it isn't it people interpret it what they're going to do. The hawkish surprise, which could include, some of the ECB members have been talking about accelerating quantitative tightening in Europe. By the way, the ECB also meets, so that's going to be some news. Apple also has its earnings. That's going to be some news just to cover the key points. But coming back, a hawkish surprise would include something um, like the most hawkish would be an acceleration of QT. The likely hawkish would be something that they've tried every single meeting to deliver, which is, hey, you guys are pricing 100, 150 basis points of cuts in the near future. We're not cutting for a long time. Could they get that? Could we get that? I expect we'll get that sort of press conference that we're pausing. If and when the data suggests a pause, we'll pause for a long time. But so far the market has completely ignored it, and I don't think there's any reason why they will start taking the Fed seriously now.
Yeah, it's quite possible. But in any case, if the Fed does something interesting or unexpected, and if we think that that is going to have some repercussions on the market and our portfolio, we'll naturally do an extra podcast on that Wednesday and post it straight away so people are aware of our thinking or our change in thinking.
Sounds great. So we'll either see you on Wednesday or things are playing out as we've discussed. So the portfolio is still defensive, still doing great in cash with, as we said, assets didn't change this month, and yet our cash accrued 50 basis points.
Yeah. So I see absolutely no reason to change our approach, especially not at these levels. I still think that bonds are not a buy. I'd rather sell them at these levels. I'm always looking for levels to sell rather than levels to buy. I don't think the yield curve is going to do anything meaningful for some time yet. I think equities are expensive, very highly valued, and we know the reason for it, but that doesn't mean that we have to follow it. One thing that we could do to the portfolio to enhance the return is sell some puts at the level that we are comfortable owning stock. And what level of SPY do you think that is, Andy?
I'd certainly start a buy and, you know, start scaling sizably into equities below 3,800.
Okay, so what we're saying is that 3,800 is a very interesting strike level. And, I why not sell some puts if that is where we want to start buying them. Something like a month and a half put, get some, if nothing else, we get some premium in, and we enhance the return of the portfolio. And if it goes down there, we can always buy some calls against the puts that we've sold, and we are in a synthetic long position.
Right. So the question I have with selling puts, and generally at this, given the mechanics of what's been happening in the market, which has been a volatility compression, a macroeconomic sort of narrowing of outcomes, significant volatility is not, in something I would expect in the next month or month and a half. But what if I'm wrong? And the market starts falling and we're at 3900 and the puts we sold are have doubled. Does that limit, because we've sort of levered up our equities? If we got assigned, we might be, at our full equity allocation. Does that limit our ability to um, add equities if we think 3900 becomes a good level?
Not really, because if we think that 3900 is a good level and we have the maths that proves it, in that case, the market's going to go back to 4100. If we, if that's what we think, we just take our loss on the on the puts, and we buy equities, and that's the price of doing business, I would say.
Right. Seems about right. So I'm interested in offering those puts. Do you think? What do you think about timing of that? Should we do it Monday morning? Or
Yeah. Look, I think volatility is not going to rise for some time, and it's more likely to fall after the Fed than rise, since we're not looking for any particular surprise. In which case, theta is going to, which is decay, over time, is going to work to our benefit. Because if we sell anything with a month to month and a half to go to expiry, within 2 weeks, that is going to be almost worth nothing.
right,
Certainly at a 3,800 strike, which is going to be what, 8% from where we are. The market is unlikely to fall 8% in a month unless something really big and significant comes out. And therefore, I'm comfortable doing that, especially because I don't think we are giving up any flexibility.
right. So I'm in your hands in terms of how we handle it. I would think selling before 2 o'clock on on Wednesday would be where the bids are going to be strongest in terms of the equity level. Who knows? Tomorrow, Monday might be a spike up, might be a spike down. We don't know. I'm in your hands, and you'll discuss that in the next
Absolutely.
segment. Okay, great.
Absolutely.
Short and sweet, and we will be back to you if something significant happens on Wednesday. Have a good day.
Absolutely. Have a lovely weekend. So the only change to the portfolio is an addition of 50 shares of EWL, which is Switzerland. None of the other bids from last week were filled, unfortunately. The XLK puts have expired worthless, so they disappear. As always, everything is in the broker statement, which is uploaded here, and you can also download. As far as orders for next week, I have cancelled all the other orders because there is absolutely no point in having them. Because if they start getting filled, you probably don't want them, because it just means that something fundamental has changed. And we always have the possibility of sending you an email if we think something important is happening, and we can reinstate some of these orders at different levels. And as we said, we will most probably have to do a different podcast on Wednesday after the Fed if something significant happens. If nothing significant happens, these orders aren't going to get filled anyway. So that's that. The only thing I will be doing is I will be selling some June 16 expiry 380 puts. Now, when you sell puts, the important thing is the strike and the end date rather than the volatility you are selling them at, because this is an unleveraged portfolio and we are selling two lots, i.e., 200 shares. We will be selling them roughly at 185 where the market closed. So that is not a lot of premium, but I really am not worried if the market starts going down because I want to buy the market before 3,800. And if it starts going down, and even if volatility goes up, the theta factor on that will be very great. So I'm really not very worried that I can lose a lot of money or that it removes any flexibility. After all, if 200 lots of SPY I get exercised on, I'll only be at around 60% allocation to equities, and down there I probably want to increase it even more. So I'm really not worried at all about this. As always, the chart pack is updated, the broker statements are updated, you have the order entry. This is the allocation, roughly 25% in each bonds and equities, and a lot of cash. So we have a lot of ability to add. Very flexible, and that is why I think selling puts, even though we're not getting a great price because of volatility, is not a problem.
Have a good day.
Absolutely. Have a lovely weekend.